Well, let me explain it this way. When I started in this business, I was a child. I'm not as old as I look. So at the interest rates were as about as inverted in the most perverse way possible. Prime rate, which changes can change daily, and usually changes, like monthly or whenever the Fed changes the interest rates, was 21%. I mean, imagine a floating rate loan at 21%. Fixed rates topped out on the longer end of the curve at about 14, 15%. So there's a 7% difference between the floating rate and the fixed rate in that scenario. Today rates have been low for so long that a fixed rate right now is the 10 years around 4.5, 460, something like that. I think I looked up this morning, and the shorter end of the SOFR curve is over 5.5. So there's about roughly 75 to 100 basis points difference between those two. That's inverted, but it's not inverted that much. And what that suggests is that the bond traders believe that fixed rates are going to go down. So they're not bidding more than a 4.5 to 460 yield on a 10-year treasury. And so the price of the treasury and the yield work in reverse. So they're, that's where it gets a little confusing and sometimes somewhat counterintuitive. So the value of a bond is going to go up or to go down as the rates go up if you already own that bond, because you're going to earn less tomorrow because you could buy a bond at a higher rate. So that's what causes the inversion of the yield curve, and it's simply that if you listen to the Fed and where they're moving short-term rates, which is all they move, the Fed only can move short-term rates. So when they're saying that short-term rates are going up, it tends to push the short end of the curve up. But then they're basically saying that our projections are that we'll start to reverse those rate increases somewhere. If you look back 6 months, they were saying they were going to start reversing those rate increases by the end of 2023. Now they're saying they probably won't move those rates back down until going into 2024. So that is why the longer end of the yield curve went up a little bit the last couple of weeks, because now it was like, oh, well, rates aren't going to go down until 2024. So